Welcome to the webinar today. My name is Erin Ellis and I work for the Philadelphia Federal Credit Union. Today we are here to talk about paying back your federal loans. Hooray. We're using GoToWebinar today and everyone is in listen only mode. There's no chat feature, but on your screen, on your GoToWebinar dashboard, you have some options. You can use the question box on the GoToWebinar dashboard to communicate with me anytime. So I can see those questions and we can use that as a sort of chat feature today. I also want to point out on the GoTo dashboard, there's 2 handouts. So you have 2 PDFs under handouts. And attached there, and you can open them, you have the PowerPoint from today, which is Paying Back Federal Student Loans 2. That's a copy of today's PowerPoint, so you have access to that now if you want it. And then the other is resources, and the resources hopefully will be really useful and helpful to you after this, so you can go forward and figure out what you need to do on your own. All right, so you can open those up and save those at any point. I will not be emailing them out afterwards unless you request them, and I'll share my email a couple of times throughout the day today, the hour. All right. Just wondering here if you're here for the first time. So trying out a poll here that should pop up. You should be able to answer it. Is this your first time attending one of our webinars? And so let me know just a quick yes or no. Is this the first time? Or have you been here before? Yeah, and if you want to write it in the questions, that works too. All right, and we'll give a couple more seconds. Oh, lots of people already voted. You all are present today, which is awesome. Maybe it is the sun. Does that help? All right, so I'm going to close the poll. Just for whatever curiosity's sake, we're like half and half. Great, so half of you have attended something else with me, welcome back, and the other half of you are new today, welcome. I do, at least I try to schedule 2 webinars a month for PFCU members or anyone in the community. They're always free. I haven't scheduled February's yet, but I am planning to do something around lowering income and increasing, lowering income, oof, not that, lowering expenses and increasing income. Looking to do something around that next month, and open to other suggestions and ideas, and there will be an opportunity, you can share them in the questions now, but there'll be an opportunity at the end also for you to share some ideas if you have for new webinar options. Okay, great. Just a friendly little disclaimer here. The information in today's session does not and is not intended to constitute financial advice. All this information, content, and materials presented are for general information and educational purposes only. So I'm not here to give you financial advice, but explore your options with you when it comes to paying back your federal student loans. Further, my background is not in finance. It's more in social work, and it is hopefully it means that I approach these topics in ways that are more helpful and easier for, you know, regular folks to understand. That's the idea. All right, so here's the plan for today. We will talk about the student loan pause. And I wonder if we would have a different attendance, you know, if more people would be here if student loans were currently due, or fewer people because we're already in the routine. But we're going to talk about the student loan pause and what that means and what's, you know, coming next. We're going to talk about repayment options. We're going to look at income-driven repayments versus the traditional repayment options. We'll talk some about public service loan forgiveness, exploring what that means too, and if you qualify, how to get out of default. Spend a very short time looking at paying your loans faster, and then we will also talk about consolidation and what that means. All right, so another poll. I love polls. It helps me to sort of gear our conversation. So quick poll, I'm curious to know, are you here to learn about paying your own student loans that you have as a student, paying Parent Plus loans that you took out on behalf of your child, or paying, maybe you have both. You have your own loans and you have plus loans that you had for your child. So let me know where you are as best you know. Great. A few more seconds for this. Again, have a really good participation rate here. So awesome. Yeah, so let me know, are you here for your own student loans? You have Parent Plus loans or both? Those, are lucky sandwich folks, right? Okay, great. I'm gonna close the poll. And just again, since we're all in this together, we've got a lot of folks looking at their own student loans and then some with those plus loans too. So we'll talk about options for everybody today. Great. And again, any questions you have throughout, you can pop them right into the question box. I will either answer them as I go or I will come back to them at the end. So the student loan pause. Currently, the new restart date for student loan payments, and everything today, I want to make clear, everything today we're talking about are federal loans. These are not your private loans, and we'll talk about how to figure out which loans are federal loans and where they are and who is the servicer and all of that jazz today. But I just want to make sure that we all understand federal loans have rules and regulations around them. Those are what we're going to focus on today. Private loans operate differently. And so a couple of times I will reference private loans or give you a little information about private loans, but in general, we're going to be talking and focusing on federal loans. So what I'm saying today will probably not apply to those private loans, but everything is going to apply to your federal loans. Okay. With the student loan pause, a few things to note. One, the pause is good through May 1st, 2022. So this May, coming up in a few months. And this includes the relief measures for eligible loans. So these are federal loans. It's a suspension of loan payments, so that means you're not paying anything. And it's a 0 interest rate, which is awesome. We're going to talk about that more later on because we're going to talk about capitalized interest and what that means. So there will not be any interest that accrued in the last 2 years when your payments restart. And that's really good news. That means that it is a true pause. So when you stopped, your loans will not be any bigger when you start again. And that, yeah, that's good. And if there are issues, your loan servicer is going to reach out to you. Right. So a lot of this information will build on itself. So what do we do to prepare to resume repayment? So this is what the Department of Education recommends, and we're going to go through this list together. Borrowers should use the additional time to ensure you have a plan to resume payments or arrange a payment plan you can afford. So the idea is right now, make this arrangement to beat the rush, because when it comes time, the end of April, you're going to likely face high call volumes and long wait times as you get closer and closer to that May 1st date. They have extended this date several times, right? We don't know, as far as we know right now, May 1st is the date and these payments are going to restart. So that's what we're planning for. We're going to look at these 4 steps, we're going to talk about updating your contact information in your student aid profile and on your loan servicer's website. So in 2 different places. Again, we'll get into this a little more in a minute. We're going to talk about your AutoDebit enrollment and how and why you might want to do that. We're going to look at the loan simulator to look at repayment plans that meet your needs and goals and decide whether consolidation makes sense for you. So again, more on this later. And then we're going to consider whether applying for an income-driven repayment plan is a good idea for you. And we'll talk about that too. And this will depend on your income and family size. All right, so let's break down each of these steps here. If I sound overwhelmed, it's because it's a lot of information. And so I want to make sure, you know, we're doing little by little as we go here. And a lot of this, like I said, is building. So if we go through something and I say something like the loan simulator and you're like, I don't know what she's talking about, that's okay. We'll get into that more. So sort of bear with me as we break some of this down and help you understand parts that you might not. And already a really good question about consolidating in the chat, and I'm going to hopefully answer that in context. All right, so with step 1 here, we're going to update our contact information, and we're doing that in 2 places. We want to log into studentaid.gov with our FSA ID. This account gives us a lot of access to our loan information. It will help you see what repayment options you have. It's the same password, the FSA ID, is what you use to complete the FAFSA. And if you don't know it, you can reset it. This dashboard with studentaid.gov gives you a lot of useful details. It tells you how much you owe, what type of loans you have, who your servicer is, and how to contact them. All really useful information. We want to know the types for repayment plan options. Do you have direct loans, FFELP loans, Perkins loans? And that information is on the dashboard on studentaid.gov. You'll also find out who your servicer is, because your servicer is the one who's going to manage your payment arrangements with you. So you'll find that out there too. Knowing these details will help you understand the choices you have when it comes to repayment. Plus, when you're logged in at studentaid.gov, you can use the loan simulator tool, and it's going to give you the most accurate information because it shows options for repaying using your actual loan balances. So that's all super useful. And here I am with my polls. I want to know, do you know how to use your FSA ID to log into studentaid.gov? So yes, no, or you're maybe unsure. Okay. And this, again, some of this is for your information, some of this is for me. I just want to know how to sort of guide this conversation. All right, so it looks like not all of you, but many of you are familiar with this FSA ID. Great. Some of you not so sure. All right, so I have a super quick video that I want to show to just give you a tiny bit more information on what you can do in this dashboard when you're logged in with your FSA ID. And it's going to say how to complete exit counseling is the video. But it's going to show you what it looks like when you log in and what options you have to explore. So I'm going to show a video. You will need the volume on your computer up. It will potentially play differently. However, I don't think the audio is, I think it's just a song. So if you don't have audio, no worries, just read the screen. All right, play the video now. Okay, so I said it was a quick video. It is a quick video just to show you how what things look like and what you can do when you do log into studentaid.gov with your FSA ID. So you know things that were really important that we're sort of looking at today that were in that video is your contact information. You want to make sure it's up to date because many of the repayment plans or some of the repayment plans require you to recertify or certify your income and your family size. So you'll want to make sure that that contact information is up to date so you can have that communication when you need it. You also can see the amount you owe, and then you can see options for repayment strategies, all within that FSA ID. And believe it or not, it's pretty user-friendly when you get in there, I'll say, pretty user-friendly. Okay, so that's your FSA ID. Next, we look at your loan servicer. So your loan servicer is a company assigned to handle the billing and other services on your federal student loan on behalf of the Department of Education at no cost to you. Well, thanks, Department of Ed. Your loan servicer will work with you on repayment options, whether it's an income-driven repayment plan. They'll work with you on loan consolidation, and they can assist you with other tasks related to your federal loans. Your loan servicer is your point of contact. So you do need these two accounts. You do want them both to be up to date. Keep your contact information up to date in both places so your loan servicer can help you stay on track with repaying your loans. Anytime your circumstances change during your repayment period, your loan servicer is the one that will help. And if you don't know who your loan servicer is, you find that out with your account on studentaid.gov. So another recommendation is to review your AutoDebit. If you sign up for AutoDebit, most federal and private student loan lenders will offer you a 0.25 percentage point reduction in your interest rate. So if you agree to have the amount coming directly out of your bank account every month, it saves you money overall and prevents you from missing payments, as long as you're comfortable having that come out of your account. Setting this up now will not cause your loans to be due before the pause ends. So you can do this now. There's no reason to wait. And while 0.25% is small now, over the life of, paying back over 20 years, it does add up. This loan simulator tool, I'm going to refer to this tool a few times today. It's a really useful tool. It's created by the Department of Education, and it helps you calculate your student loan payments and choose the loan repayment option that best meets your needs and goals. So you might be struggling to make a payment and need a lower payment amount. You might want to fast track your student loans, and you have a goal of paying them off in less time. You can use it too. It will help you determine whether consolidation is the right option for you. And then exploring an income-driven repayment plan. Consider applying for an income-driven repayment plan. It can make your payments more affordable depending on your income and family size. And your loan simulator tool will help you see these options. We're going to spend more time reviewing the repayment plan options, both income-driven and traditional today. So a few definitions here, and these definitions are all linked with financial consequences. And so I want to talk about them each a little bit. If you expect you'll need an additional break after May 1st, you can apply for an additional pause if you need it. There's an unemployment deferment for up to 36 months or a hardship forbearance for up to 12 months at a time. But unlike the current pause, the interest will accrue and be added to the total you owe when you do start paying again. We'll talk a little more about that. So there is a sort of cost that comes along with deferral and forbearance, depending on whether your loans are subsidized or unsubsidized in deferment. So first, let's talk about default. And the idea is we want to avoid default. And at the end, we'll go through options. If you're in default, how you can help yourself to get out of them. So for most federal student loans, you can be declared in default if you have not made a payment in more than 270 days. Private loans are quicker. They usually go into default as soon as you miss 4 monthly payments. Missing payments or paying late is bad for your credit history, and it makes it harder to dig yourself out of debt. If you're having trouble making payments, or you think you're going to be unable to pay come May 1st or at any time, contact your servicer immediately. You don't want to wait until your loan is in default. There are very serious consequences to default. They will snatch your tax refund, garnish your wages. That means they take money right out of your check, and you end up paying more than you would if your loans remain in good standing and you pay. So that's default. So to avoid default, certainly there are options for payment plans, which we'll get into next, but there's also an option for a deferment, and you would apply for a deferment through your servicer. It's a temporary pause to your student loan for specific situations. If you are on active military, re-enrollment in school, or unemployment, and there are a list of reasons that you can find in addition to those. Now with a deferment, if you have a subsidized loan, and you'll be able to see using your FSA ID when you sign in, do you have a subsidized loan or unsubsidized loans? Subsidized loans do not accrue interest during a deferment. So that means, just like the pause, the loan looks the same when you start your deferment as when you end your deferment. However, that's not the same for unsubsidized loans. With an unsubsidized loan, during your deferment, the loan still accrues interest. And if you don't pay the interest as it accumulates, it's added to your loan balance at the end of your deferment. The amount you pay in the future is going to be higher. We'll look at this a little more in detail because it's something to consider when you're thinking about your options. So there is this sort of cost of deferment, right? There's no fee to do it, but you might be paying that interest. Well, you will be paying that interest on the unsubsidized loans. And in forbearance, you apply for forbearance. Sorry if my audio is cutting out. If you apply for forbearance, that would be also through your loan servicer. And during forbearance, all of your loans accrue interest. So these are temporary solutions, but definitely not long-term solutions. Remember, these are both short-term for financial difficulty. Income-driven repayment options are much better if your financial difficulties will last more than 3 years. Whatever the case may be, it's best to contact your servicer immediately so that you can start making arrangements and not go into default. All right, I'm going to launch a poll and switch my internet to see if I can make sure my audio is working well. All right. Just for, again, the sake of understanding and speaking to the audience in the best way possible, let me know your student loan totals. I won't share this, but just to say, or maybe I will if it's useful, you know, how much debt are we looking at? All right, a couple more seconds to let me know. All right. Well, I'll let you know the majority of the group is at the 50 and over mark. And then, the rest of you are over 20. So, this is significant, right? This is significant. And so, when it comes to interest, we're talking about significant amounts of money. So let's look at, I mentioned capitalization of interest, and I want to talk about what this means, because this is something to consider when you're consolidating your loans. It's something to consider when you are choosing a deferment or a forbearance. So what is capitalized interest? When you make monthly payments on a student loan, a portion of your payment goes towards the interest accrued since your last payment, just like any loan, and the remainder goes toward paying down the principal of the loan. During times of deferment and forbearance, interest may still be accruing on your accounts. The exception to this is the subsidized federal loans with a deferment. So once you start making payments and your deferral or forbearance is over, lenders typically add the interest that accrued during that pause to your principal balance. This not only increases how much you owe, overall that becomes your new principal, but it also increases how much interest you pay, because now you're paying interest on a higher principal, on a higher balance. So how do you avoid paying this, additional interest capitalization? If you're able, you can make interest-only payments while you're in college and deferment on your unsubsidized loans. It's not always possible if you're in deferment due to a financial hardship or you're not earning income, but it could save thousands of dollars in the long run. And so the income-based, the income-driven repayment plans are going to be really good options no matter what your income. So here's just a little example looking at the original loan if I was capitalizing the interest on this. And the example is deferment. These are unsubsidized loans. The same would be true with a forbearance. So it's going to be all the same numbers. So my original loan is $35,000. My current monthly payment is $379. So my 12 months pass and $1,925 accrues in interest. So the new balance then, that interest is added to that 35 that I owe. So now my new balance is $36,925. Now I'm actually charged interest not on that 35, but on that $37,000. So my monthly payment then increases because my interest, I'm paying more in interest. So the real cost of that deferment to me, by the time I pay my student loan back over the next 10 years, is going to be about $2,500. So it's just something to keep in mind when you are thinking about forbearance and deferment, because those income-based plans might be a better option. So speaking of repayment plans, we're going to get into the different repayment options here. Like much of this, student loan repayment plans can be complicated because there are a lot of options. But one of the big benefits of federal student loans versus private student loans is the variety of repayment options available depending on your family situations. So we have 3 traditional repayment plans, and I've broken them down on the slide. We have the standard repayment, graduated repayment, and the extended repayment. So the standard repayment, you pay the least interest and you get out of student loan debt the fastest. It's the basic plan for repaying student loans. You're automatically placed in this plan when you start repayment unless you select a different option. And here are some of the key details. You have a repayment length of 10 years. Total payments are 120, and your payment amount is the same each month. Qualifications, these are for federal student loans. This is going to limit the amount you pay overall, the standard repayment plan. Plans under this plan are larger than other repayment plans that give you more time to pay. You'll pay the least amount of interest in the standard, and you'll finish the fastest. So if those are your goals, you want to stick with that standard repayment plan. Generally, any plan that decreases your payment is going to increase the amount you pay overall because you'll be paying more interest. So if you can afford the standard repayment, best idea is to stick with it. Now, most of you who shared your student loan amount, if it's one of those big numbers, then this standard might not be realistic. So let's look at other options. So then we have the graduated repayment plan, and I'm not sure who this is for because it lowers your monthly payments initially, but can lead to very, bigger bills later. It's for students who want lower monthly payments, but they increase somewhat significantly every 2 years. So you'll see, 10 years, same as the standard 120 payments, but they do increase every 2 years. And I have an example of this next. So it makes sense to do the graduated repayment if you want smaller payments, but you earn way too much money for one of those income-driven repayment plans. So it's there, right? That's who that's for. And then the extended payment. So these anyone can qualify for. You do not need any income qualifications to qualify for these. However, if you're going to do the extended repayment, you must have at least $30,000 in federal student loans. So the extended plan lowers your payments by stretching your repayment period for up to 25 years. And you can either have it fixed, so it's the same amount every month, or graduated so that every 2 years this plan increases. So those are the traditional repayment plans that you can qualify for regardless of your income. And this is some information, we're going to revisit this example here. This is from the loan simulator that I mentioned at the beginning. So what I did is, rather than using real loan balances, I took the average. So they said the average student loan for an undergraduate who graduated with a four-year private school is $38,000. I'm sorry, $34,000. So we're looking at a $34,000 loan balance. Looking at that $34,000 loan balance, for the scenario we're using throughout the session today, income is $38,000 approximately, and the family is 2 people, so like 1 borrower and 1 dependent. And now remember, in this scenario, none of that matters because with the traditional repayment plans, income is not a consideration and family size is not a consideration. So it doesn't matter. But you can see basically, what we see here is that standard repayment, $350 every month for 10 years, pay it off. The total paid principal of $34,000 plus that interest will give you $42,000 paying it back in 10 years. With the graduated, you start at about $200 a month, and every month it increases, every 2 years it increases until you hit that $587 mark in year 10, year 8 in this case. And then you have the extended fixed repayment. And the main difference here is how much you pay total. So you pay it off for a lot longer time. You won't be paid off till 2046, and you pay $54,000. but that might be the payment that you need in order to afford it. So if those plans are not right for you, you have options for the income-driven repayment plans that we'll talk about. And I have, under this, we're going to look at who might want to apply for one of these plans. Switching to one of these plans is usually right for you in the following instances. You can't afford your current payment and want to avoid late payments and default, right? So none of those options I gave you on the last slide were good for you. Let's consider these. If you qualify for public service loan forgiveness, ding, 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 let's talk about it. These are the payment plans that you will want to use to repay your student loans. So there's another reason this is right for you. And if you have high student loan debt and a low income, right, or a lower moderate income, or you have no income, you're unemployed, these are good. These might be the right options for you. So the federal government offers 4 income-driven repayment plans that can lower your monthly bills based on your income and family size. It can be as low as 0 if you're unemployed, or if you earn less than 150% of the poverty threshold. We'll look at that a little bit. All of these plans that we're going to talk about next share some similarities. Each plan caps payment between 10 and 20% of your discretionary income, and it forgives the remaining balance after 20 or 25 years of payments. The 4 plans under the income-driven repayment options are the income-based repayment, revised pay-as-you-earn or repay, pay-as-you-earn or pay, and income contingent repayment. Okay, so it sounds good, right? Definitely affordable payments. However, there are some disadvantages, right? If you are someone who might qualify for public service loan forgiveness, these are going to be really good options for you because these are the loans that will qualify. So speaking of public service loan forgiveness, and I see a question in the chat about it anyway. I'm curious what you know about it. Do you, so I'm launching a poll, do you qualify for public service loan forgiveness, or, you know, do you think you do at this point, right? So yes, no, not sure, let me know. And if you're not sure, that's okay too, of course. All right, a few more seconds to do the poll. Do you qualify for public service loan forgiveness? And this is not a mystery, and we'll talk more in detail, but this is based on your employer. So if you are employed by in a public service job, and we'll talk more specifically. And you notice, you know, my language, I'm being cautious because it's not where you work, it's who you work for that matters. So that's why I'm sort of being a little careful with this. Okay, so it looks like we have, no surprise, just for, you know, information, a lot of folks here who do qualify for public service loan forgiveness, some who aren't sure. So you might too. So, and if not, that's okay. We got you covered too. But this whole section here on income-driven repayment plans is going to be good for anyone who thinks that these are good options, and for sure, anyone who qualifies for public service loan forgiveness. And I'll go through some of the requirements around public service loan forgiveness. And then we'll revisit it in a little more detail because there's a lot of changes going on right now in this program, which is great because up until this point, it's, if I may, been a mess, if I may say. The public service loan forgiveness program forgives the remaining balance on your direct loans after you've made 120 qualifying payments under a qualifying repayment plan while working full-time for a qualified employer. And like I said, a lot of specifics here, and that's why I read that. So qualifying monthly payments, qualifying repayment plan, qualifying employer, and full-time. So if you are going to qualify, you must be employed by a government or not-for-profit organization. And there's a way to verify that, and we'll look at that. You must work full-time. So if you are only part-time, under 30 hours, then you would not qualify for public service loan forgiveness. However, do more research, right? And keep sort of investigating that and looking out for changes that might come or adjustments, because this program is under a lot of changes. You must have direct loans. And if you don't have direct loans, you can consolidate them into a direct loan. For public service loan forgiveness, you must repay under an income-driven repayment plan. And you must make 120 qualifying payments. All right. So let's look back for everyone now at those income-driven repayments. So we're going to backtrack a little. So with these payments, for everyone, you'll pay more interest over time. It will extend your payment from the standard 10 years to 20 or 25. There's a lot of unless you qualify for public service loan forgiveness, little caveats here. Since you're going to be paying your loan for longer, right, between 20 to 25 years, you're going to have more interest that will accrue on your loans than the standard repayment. There's also another change. Right now, you will not pay taxes on your forgiven loan balance. So say you're in an income-based repayment plan for 20 years, and there is a portion of your student loans that's going to be forgiven at the end of that. Prior to recent change in the law, you would pay taxes on the forgiven balance. This is not true if you qualify for public service loan forgiveness. However, just to confuse us, until 2026, you will not be paying taxes on your forgiven balance. I hope I didn't lose everyone here. It is possible, though, that sometime in the future, the balance on your student loan that's forgiven, you will be required to pay taxes on it. We're hoping that that law changes, right? We're hoping that forgiven is forgiven and you don't have to pay taxes on it. And if you have questions about that, I would be happy to answer more of those. Let me just check in the questions here. Okay. And again, I'm going to say, because I have a couple of people in the questions, you know, like I think somebody said they just missed it because they just retired with student loan repayment, or maybe working part-time, things like that. Just keep paying attention, because these programs have been sort of, they're changing right now, like this tax issue. All right. This is a lot more information. It's already almost 1 o'clock. So here we go. All right, we've got these income-driven repayment plans. Your spouse's income could factor into payments with these plans. And so you'll get different recommendations when you log in to studentaid.gov about which payment is going to be better for you based on how you file taxes. And so that's going to sort of populate for you. The least confusing way to select a plan is to let your servicer place you in the one you qualify for that has the lowest monthly payment. And you can choose that option when you complete the income-driven repayment plan application. So you log into studentaid.gov and you look at repayment options, and it will show you what's available. So these are the breakdowns of the 4 income-based repayment plan, income-driven repayment plans. The ICR, or income contingent repayment, this is the one that's for parent borrowers. So those of you who are working on plus loans would only be able to use the income contingent repayment plan. So that means that you're going to look at a payment of up to 20% of your discretionary income, and that's based on your income and your family size, or a 12-year term. And these are for parent borrowers. So that's what that is for. Somebody asked me to repeat something and I missed what I was repeating. So I'm sorry. A direct loan is a federal loan, but it's a federal loan. It depends when you received your student loans or if you consolidated them. So a direct loan is the one that's going to qualify for these repayment plans if you don't have direct loans because you borrowed before direct loans were in play. You have maybe a FFELP loan or a different loan. You can consolidate it to make it a direct loan. And when you have that direct loan, so yes, a direct loan is basically, it's a federal loan. And so how do you apply? You decide, yes, I want the income-driven repayment plans. How do I apply? You apply through your studentaid.gov account. You must do the whole thing at once. It takes about 10 minutes. And then you will need to verify income. So you need to provide information about your family size and your most recent federal income tax return or transcript. The IRS data retrieval tool is the easiest way to access this. If you do file taxes. And so when you're in your studentaid.gov, it will link it up and import your tax return information, which is great. If you didn't file taxes, you do need to submit alternative proof of any taxable income you've earned in the past 90 days. You can change your student loan repayment at any time. It's important to note when you apply for your income-driven repayment plan, your interest is capitalized. So we talked about what that meant, right? So, just considering it, but because it's an income-driven repayment plan, you're probably going to end up paying less in the long run because some of that money will hopefully be forgiven after the 20 or 25-year repayment period. So this becomes a problem, the capitalized interest, if you fail to recertify your IDR plan. So what does that mean? When you fail to recertify, you'll be removed from the plan and your interest is capitalized. So how do we recertify? And this is anybody in one of these income-driven repayment plans, whether you're public service or not. You must recertify your income and family size every year in order to keep this plan. If your income changes, your payments will change too. If you miss, which is, for better for worse, right? Increasing or decreasing depending on your income. If you miss the recertification deadline, you'll have to pay more. And that'll be likely the standard repayment amount until you re-enroll, which you can do at any time. But that is the time that your interest will be capitalized. So it's in your best interest to stay on this plan and recertify. You'll get notice from your servicer. They will let you know when your paperwork is due. It's super smart to complete the process when you first learn of this date, even if it's months before your deadline. This will ensure you don't forget to recertify. And it's not going to change the due date until, change the amount due until that year is up. Recertifying online is faster and easier. And you can just access those tax records through studentaid.gov. It'll confirm it with all your servicers. You'll also have a digital trail, and that can be handy if the servicer, loses track of your paperwork. Okay, so this, using that same student loan balance of just under $35,000 with one dependent, you can see the pay option, IBR, and repay, and these look really similar in this scenario, but you'll see, your monthly payment, you're looking at $99, and that's because it's based on my income, $38,000 a year salary with one dependent, and then it does increase. You'll see at the end it's going to be $214, and that's because I set it up saying that I plan to get a raise, hopefully, of 3% every year. But if you don't get a raise, that amount won't increase because it's based on your income. So how much am I paying total? About $36,000. And the amount forgiven is going to be $23,000, which is wildly significant, right? Even if my loan balance is higher, I increased it in an example to $57,000. The payment amount stayed the same because they're based on my income. So no matter your loan balance, the details will look the same. So back to public service loan forgiveness. We talked about how to qualify for it. And you must be employed by a U.S. federal, state, local, or tribal government, or not-for-profit organization. You must work full-time. You must have direct loans, or consolidate other federal loans into a direct loan. You must pay under one of these income-driven repayment plans, and you must make 120 qualifying payments. Now, there are tons of changes that will be happening with this. And to be honest, we probably don't have time to get into all of them. I can come back to this. If anyone can stay past one, I'll do sort of a mini session on public service loan forgiveness at the end. We will come back and visit this and talk about the changes. I will say the changes are really positive. And previously, people who thought they qualified for public service loan forgiveness didn't. And so the Department of Education is working to rectify that. And so therefore, payments you made previously that didn't count are going to be included. So again, we'll come back to this if you're able to stay a little at the end. Yes, I see people already asking, like, tell me about the waiver. Okay. And I'd be happy to get into this a little more as best I can, because I too am learning about it and figuring it out as we go here. So with public service loan forgiveness, you must recertify your income and family size every year. This is the same for everyone who's on an income-based repayment plan. You must also certify your employment every year. And you do have to actually print a form and give it to your employer to complete and then submit it. And you're absolutely going to want to do this every year because you want to keep track of your progress and make sure that you are moving in a forward direction. Make sure that your payments are counting toward your public service loan forgiveness. So these two things are going to be important for public service loan forgiveness. And here's an example about that same loan. This time we qualify for public service loan forgiveness. So we're looking at the same 3 repayment options. We start with the same amount. And instead of 20 years, we're done after 10 with public service loan forgiveness. So you'll see the amount paid is much less, $14,000. And then the amount forgiven is much greater. So it's certainly something to think about when you're thinking about employment opportunities. All right, and I will do questions at the end. Again, I just want to get through all of this. This is if you can't tell, you probably can, the first time I've done this presentation, and things continue to change in terms of paying back student loans due to COVID. So there's a ton of information, and next time I'll have more time. So I'm going to get through this and then save questions, and like I said, a mini session on public service loan forgiveness at the end here after we're done. There are two options for getting out of student loan default, and one is a lot faster than the other. Student loan, getting out of default, you can do a student loan rehabilitation, and that will take more time because you need to make 9 monthly payments over 10 months. But your default status is removed from your loan. So it's a one-time only get out of default card if you can afford to do it. And it's based on your income. That's loan rehabilitation. Your other option, if you're in default, is loan consolidation. This happens very quickly. You can apply for one of the income-driven repayment plans. And then either way, once this is done, you're eligible for deferment, forbearance, and additional federal student aid. So two options. One is quick, one is not. One has a better result on your credit than the other. However, with both of them, they're going to show missed payments if you are in default. And consolidation. So consolidating your loans means you take multiple federal education loans and put them into one loan. You combine them, and the result is a single monthly payment instead of multiple payments. It's important to know there's no application fee to consolidate your federal education loans into a direct consolidation loan. You might be contacted by private companies that offer to help you apply for direct consolidation loan for a fee. These companies have no affiliation with Department of Education. So you do not need to pay anyone for any assistance getting a direct loan consolidation, getting on one of these income-based repayment plans. The application process is easy and free. So if you currently have student loans, there are some pros. You might want to consolidate to get onto an income-based repayment plan. That's one reason. Might want to simplify your payments, giving you one loan with one monthly bill. Let's see what else. You can switch your variable rate loans and make them fixed interest rate loans so that that interest rate doesn't change. On the other hand, some of the negatives associated with consolidation, because it usually increases the time period that you pay your student loans, you'll likely make more payments or pay more interest than if you didn't consolidate, right? If you had the standard repayment plan. And we talked about that a lot today. And so I think we hopefully understand the good and the bad that comes with it. When you consolidate, the interest is capitalized, right? So your interest is then going to accrue on a higher principal if you hadn't consolidated. But again, if we're looking for those huge amounts of loans and we're looking for potentially forgiveness in 10 or 20 years, this might or might not be a factor. Consolidating certain types of loans, you could lose certain benefits. If you have a really low interest rate loan, you might lose that interest rate. It will be actually averaged out. If there are cancellation benefits, like there are with some Perkins loans, you could lose that. But it's important to know when you consolidate, you decide which loans to include in a consolidation. So if there is a loan that you have that has a benefit you don't want to lose, and a Perkins loan would be an example of that, you might want to leave it out. And so that would be something when you log in, you can sort of look at those details, and it will let you know if it makes sense to do a consolidation or not. Phew. And I just want to mention too, should you refinance into your federal student loans into a private loan? When you do that, with your federal student loans, you have certain rights that aren't typically available with private loans. Refinancing your student loans into private can sometimes lower your interest rate, but your private loans isn't going to have necessarily the same terms and conditions, and you're not going to have access to temporary payment relief like forbearance and deferment and things like that. So, so you do have a lot to lose potentially if you refinance into a private loan. You lose all those benefits of your federal loans. And those are the ones we spent the last hour and 5 minutes talking about. I'm not going to talk about paying loans faster. Basically, you want to pay your loans faster, you pay more, right? We know how to pay loans faster generally, but I do want to point out, and I was just talking with my sister about this morning. She was like, this one student loan that I still have, the interest rate is so low that it doesn't make a ton of sense to pay it faster, because it makes more sense. Like with any student loan, you want to pay down your highest interest debt first. So before you're worrying about paying your student loans faster, make sure you're paying your high interest debt first. You want to have an emergency savings fund, because that's going to be extremely important in preventing debt down the road and caring for your family. Thinking about other savings goals too that you might have. So a lot to think about. I'm not saying don't pay them off faster. I'm just saying think about, consider all your options. All right, so we have our action items again from the beginning to work on these things now before those student loan payments are due on May 1st. I'm sorry, the payment is not due. The pause ends. You will get notification of exactly your payment due date. So we talked about updating your contact information, reviewing an AutoDebit enrollment for, if you have one, sign up for it. If you don't, if you can, if you want it. Check out the loan simulator and think about those income-driven repayment plans. You can really see all your options and decide what's right for you. Okay. I am going to share with you now the resources, revisit the questions. So for those of you who need to leave, thank you so much for coming. I'm sorry we're over time. I wasn't sure if this would take, 2 hours or 15 minutes, to be honest with you, even after practicing it, just because, it seems like everything, there's just more and more information the more I get into it. So I appreciate your patience with the time. If you want to stick around, I'm going to do a question and answer portion, and I'm going to talk about public service loan forgiveness. So if you're able, hang out for that. If you are leaving now or later, when you X out, there will be a survey. It's extremely helpful if you can fill that survey out. It helps us plan more programs. The reason I did this is because of feedback from those surveys. So it matters. Fill it out. It's 4 questions. It's very short and very easy and multiple choice for the most part. So I would appreciate that when we are done or when you leave. All right, I'm going to catch a breath real quick. While I share for you, on your screen, you should see the resource guide. And so a lot of the tools I talked about today are linked right here. So I've got a really simple to read sort of brochure, and I like how simple it is, from Department of Ed, just generally on repaying loans and what your options are. A link to log in with your FSA ID. We talked about that ad nauseum, a link to the loan simulator, a link to all the changes with the emergency relief, federal student aid. And then you've got a few valuable websites when it comes to public service loan forgiveness, and then a debt resolution contact center. If you are in default, this is a great way to get in touch with the people you need to in order to rehabilitate or consolidate your loans. A few additional resources from Consumer Financial Protection Bureau, more to consider when deciding if consolidation is right for you. How to avoid scams, super important. There is a lawsuit against Navient that will get many people student loan relief. It's about $250 worth. So stay tuned for that. But if you want more information, you can take a look at that. And that's the Debt Resolution Center. I have that on there twice, apparently. Okay, so those are the resources. I am going to leave my email here. And check in on the questions. Oh, I'm guessing everybody's here for, yeah, the resources are linked on the dashboard, as are the PowerPoint slides. So under handouts, you can open those PDFs and save them. If you're not able to do that, or if you're on your phone and you want them, email me, ellis@pfcu.com, and I can send those out for you if you don't have access to them. All right, so, okay, a few people saying they're gonna stick around. So let's go back to public service loan forgiveness and get into that a little more. We'll talk about the waiver a little bit. And I'll check on questions. I love some of the questions. Can you talk more about having an emergency fund before paying loans? Yeah, I'll talk about that when I get my slides. It's like my favorite topic. Yeah, I mean, if we think about what happens when, you know, there is an emergency or, you know, something comes up, if I pay into my student loans, you know, say I have $500 extra and I pay that into my student loans, and then I need new tires, I can't get that money out of my student loans. So what do? I might end up using a credit card and maybe then paying interest on that $500. I might end up struggling with other bills because I use cash that month that normally would go to other things. And so maybe now I'm hit with some late fees. Maybe I have to make some really hard choices about what bills to pay or what, you know, what my family needs. And so in general, that emergency fund is really the building block of all of our other financial goals, or most of our other financial goals, because that can do a lot to really help us prevent other costs and prevent other hardships down the road. I'm sure someone else could add a ton to that. So that's my like little 2-second coverage there. All right, so jumping back into public service loan forgiveness, and again, I will come back to questions after this, but let's look at these public service loan forgiveness. There is literally, and I have this up here just because I find it amusing. From November 8th, Richard Cordray is the Chief Operating Officer of the federal student aid, and he wrote this letter to public service workers that said basically the changes are real and significant, but right now, please understand that complex changes of this magnitude are hard to process and execute. Right now, they're a mess, is essentially what they're saying, but they're going to figure it out and it's going to be better, is the idea. So let's talk about these new rules with the public service waiver. All right, so previously with public service loan forgiveness, you had to be, your payments only counted. We see this magic 120 qualifying payments. Your payments only qualified if you were in one of these income-driven repayment plans. So if you made a different arrangement with your loan servicer and it wasn't one of the IDR plans, none of your payments counted. So for, 20 years or 10 years or whatever, you've been working for, you're a social worker and you're working for this company and none of those payments counted, even though you were working in public service for all those years. Because if you didn't have the right payment plan, those payments didn't count. So if you were on an extended repayment plan or those payments just didn't count. And so when this 10 years came up a few years ago and the first people were supposed to have loan forgiveness didn't get it, it was sort of discovered and uncovered that there were giant flaws in this system. So what's going on now? Oh, the other part of this, and someone asked about retirement, so hopefully you're still here for this conversation. It used to be, again, old rules, that you only qualified for forgiveness if you were working at that employer at the time you applied. So if you were retired, those 120 payments you made over your career didn't count because you weren't still working for that employer. And this is no longer the case. So now, and there's another deadline here. You have until October 31st to make sure that you're in a qualifying payment, or at least your loans are, yes, you're in a qualifying payment, which means your loans are direct loans. I'll sort of explain that more in a second, hopefully. Here are some of the changes, so I'm going to let you know what they are. Actually, I'll share my notes with you. I know they're really small, but this is what we're looking at. So we talked about the normal public service loan forgiveness requirements, and then we're talking about the changes that will apply until October 31st, 2022. So now, if you made payments on any type of loans, direct, FFEL, or Perkins, that would be like all of your federal loans, you will receive credit for repayment on all of those, which is great. You will receive credit for payments under any loans that you were making while you qualified for public service loan forgiveness. Even if you were on the wrong repayment plan, even if your loans were not consolidated, you will qualify even if your past payments were made late or for less than the amount due. And this is through, last September. So that's really good news. So basically now, looking at folks who were working in public service, even if your old payments didn't count before, now we can go back and now we're going to count them, which is great news. And all these past payments count even if, I said this already, I think, they were late or less than the amount due. The main thing, the main qualification is that you are employed full-time for a qualifying employer. You can receive forgiveness even if you're not employed at the time of application. So maybe you get a big cushy job now, or you're retired. By cushy, I mean for-profit. But you had those 10 years, then you would qualify. So these are some of the changes which are definitely positive. And again, they said that there are still adjustments being made to this. I'm going to go back to the slide now. But those are some of the changes. Let's see if I've missed any more. You can also temporarily self-report your income. All right. So I think those are the main changes. Sorry, I'm just reviewing my notes as I'm also digging through all of this new information. And I'm going to go back to the resources and show you what you might find useful here. So 2 things. Oh, this is what I wanted to show you. So there's more information on the waiver, which is what I talked about. That's those differences in who qualifies for public service loan forgiveness that I was explaining. And so with this tool, the PSLF, I feel like it's not any easier to say PSLF than it is to say public service loan forgiveness. There is a help tool. And so you can log in and check your employment here. So it's a useful thing to do to, yeah, and this takes a little longer, 30 minutes rather than just the regular IBR or the income-driven repayment. But you can take a look at this and see about your employer. And I do have a link to this too, to this really corny article called Become a Public Service Loan Forgiveness Help Tool Ninja, where it helps you figure out, talks about temporary expanded public service loan forgiveness. This is the waiver, helps you navigate the employer database and the employer's EIN and sort of figuring out where to get that and how to get that and what that is to help you make sure to qualify. So those are linked in the resources. Okay. Okay, so I'm revisiting the questions now. I'm going to work through what I can. It's 1:21, so that was the sort of covering what I wanted to cover. I will stick around and answer questions. If you got all the information you were looking for, please complete the survey when you X out. If you want to stick around for questions, great.